Hey guys, it is Julie here with TipRanks, and today we're taking a look at 3 top analyst stocks that have been dipping in price. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 stocks that have been trading in the red lately, but are still picking up buy ratings from some top ranked analysts. We're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. We found these companies today using the top analyst stock page on TipRanks. Found right under the Ideas tab, here you'll find stocks that have been picking up buy ratings from 5-star analysts. We focused in on strong buy stocks with a large or mega market cap, and then I sorted by recent stock behavior, focusing in on those that were in the red recently. Just before we get into today's companies, this is your friendly reminder that if you enjoy the video, make sure you hit that thumbs up button and that you're subscribed to the channel. You can also download the TipRanks mobile app to access all your favorite investment research tools on the go by following the links in the description down below. Now let's get right into our 3 top analyst stocks. First on the list today is Dell Technologies. They trade under the ticker DELL, currently priced at $109 per share. Now, year to date, the stock is in the green, having gained 45%, but in more recent months has fallen, losing over 19% in the last 3 months. Dell is a technology company that is largely known for selling desktop and laptop computers. But now the company is adapting to current trends and focusing on areas of growth, including cloud computing, security software, mobile, and of course, artificial intelligence. In 2023, they announced a broad generative AI infrastructure portfolio and has had a busy year of AI development, and they anticipate a continued enterprise evolution of Gen AI and quantum computing. Dell has worked with NVIDIA on their Dell AI Factory, which is the industry's first end-to-end AI enterprise solution, integrating Dell's compute, storage, client device software, and services capabilities with NVIDIA's advanced AI infrastructure and software suite. So while Dell may not be the first name you think of when it comes to artificial intelligence, they are certainly making some efforts in that area. They also came out with a Q2 earnings and revenue beat on August 29th. Their Q2 earnings per share of $1.89 came in 17 cents ahead of analyst expectations, and revenue of $25 billion was up 9% year over year, beating by about $910 million. They also saw record Infrastructure Solutions Group revenue of $11.6 billion, which was up 38% year over year. A 4-star analyst from DBS recently weighed in on the Dell Technologies stock, rating it a buy. Believing that the Dell stock is well-positioned for growth, they said the firm's strategic moves in the AI space and its current market shares in PCs, storage software, converged systems, and mainstream servers provide a solid foundation for their optimism. Their recent launch of AI-enabled PCs, developed in partnership with Microsoft, represent a significant innovation in the market that could drive new growth. Dell currently has 15 analyst ratings, coming in as a strong buy based on 13 buys and 2 holds. And the average price target of $147 would imply an upside potential of 34.5%. Looking at those ratings down below, we can see several 5-star analysts weighing in on the stock, all with some double-digit upside potential. Our low end is this one hold here at 106 with a downside of nearly 4%, while our high-end price target is 185 for an upside of over 67%. Next up on the list today is Halliburton. They trade under the ticker HAL, currently priced just shy of $30 per share. Their stock is down 17% year to date, and in the last 3 months has fallen over 11%. Halliburton is in the energy sector, providing products and services for the oil and gas industry. They are a global leader in the so-called upstream oil industry of petroleum exploration and production, offering oilfield services, engineering, and construction worldwide. They create innovative technologies, products, and services that help their customers maximize their value throughout the life cycle of an asset through different areas such as subsurface, well construction, completions, abandonment, and integrated services. Just a couple of weeks ago, Halliburton was impacted by a cyber attack. The cyber attack incident did force the company to shut down certain systems and did disrupt some of their operations in their North Houston campus and global connectivity networks. The company said that they activated their cybersecurity response plan and is working with external experts to address the incident. Also putting some downward pressure on the stock was the company's Q2 report, which they shared in mid-July. Earnings were in line with expectations, while revenue did miss and was relatively flat over year due to some weakness in their North American business. Their second quarter earnings per share came in at 80 cents, which, like I said, was in line with estimates, while revenue came in at $5.8 billion, which missed by about $120 million. That revenue was up by about 1% year over year, but North American revenue had fallen 3% to $2.5 billion, hurt by a drop in pressure pumping services in the U.S. land business. But despite this, analysts are still bullish on the Halliburton stock, including one 5-star analyst from Wells Fargo. They said that despite revising earnings forecasts downward to align with the company's updated guidance on the third quarter margin ranges, they maintain their buy rating and positive stance on Halliburton, highlighting it as the preferred stock among the top 3 oilfield service companies. Their confidence is supported by the company's solid return on invested capital, which is estimated at 17% for the current year. And in addition, their unchanged capital expenditure guidance signals a stable investment strategy by the company. With 15 current analyst ratings, the Halliburton stock does come in as a unanimous strong buy. And the average price target of $44 would imply an upside potential of nearly 49%, and we have a fairly close group of price targets here. Our low-end price target is $40 per share, and there's several of those, which would still be an upside potential of 35%, while on the high end we have a couple at $48 for an upside of over 62%. If you've made it to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Third on the list, we're taking a look at CrowdStrike. They trade under the ticker CRWD, currently priced at $262 per share. Year to date, they are up 3%, but they did notably take a big dip here back in July. In the last 3 months, the stock is down 23%. CrowdStrike is a cloud-based cybersecurity company. Their cloud-based endpoint protection solutions prevent and respond cyber attacks. Their flagship product, Falcon, uses AI to detect intrusions across networks and endpoints. They claim that their technology can detect 99% of all malware threats before they impact a device or organization. But CrowdStrike made headlines and took that big dip back in July when one of their system updates caused a massive outage with Microsoft. Microsoft users worldwide faced the dreaded blue screen of death error, and this caused massive impacts for many industries around the globe. So of course, this did shake investor confidence in CrowdStrike, and they did address this in their Q2 earnings report last week, where the company came out with an earnings and revenue beat. They reported Q2 earnings per share of $1.04, beating estimates by 5 cents per share, and revenue of $963.8 million, beat by over $5.5 million. Their ending annual recurring revenue grew 32% year over year, and they delivered record Q2 operating cash flow. Management said that we're working with customers to recover from the July 19th incident. We emerge as an even more resilient and even more customer-obsessed CrowdStrike, continuing to aggressively invest in innovation. And Wall Street analysts are largely staying behind the CrowdStrike stock despite the July fumble, with one 5-star analyst from Bank of America recently weighing in. They noted that despite recent challenges, the company's proactive management of the global outages fallout through customer retention plans demonstrates their commitment to maintaining long-term customer relationships. By offering discounts, extended contract terms, and flexible payment options, they're not only managing short-term recovery, but also setting the stage for future monetization opportunities upon renewal of additional modules. CrowdStrike has 40 current analyst ratings, coming in as a strong buy based on 34 buys, 5 hold, and 1 sell. And the average price target comes in at $325, implying an upside potential of 23.5%. Looking at all of our ratings down below, we can see a lot of analysts adjusting their price target, both increasing and decreasing. Our low-end price target comes in at $265 from Scotiabank, which would pretty much be a flat price target from here. And scrolling a ways back, our high-end price target comes in at over $400 for an upside of nearly 60%. So there we have 3 stocks, all recently trading in the red, but still picking up some buy ratings from 5-star analysts. Let me know your thoughts on these companies in the comments down below. I always appreciate hearing from you guys. Keep in mind, these videos are never a suggestion to buy or sell any specific stock, just showing you what those Wall Street analysts are up to. So please make sure you always stick to your own investment plan. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.